seen this footage of people running into stores to grab as much Coca-Cola as possible? Now, in case you're thinking this is some kind of joke or prank, it's not. People are literally stocking up on Coca-Cola because they expect prices to skyrocket soon. And if you take a closer look at these people, you'll see that many of them are buying cases upon cases of Coke, which suggests that they have some kind of emergency stash planned. And it gets even crazier when you see how much they're paying for it. Some people are spending over $1,000 on Coca-Cola, but they're still getting a really good deal, which means that things are about to get way more expensive. In fact, a new report just revealed why we have unseen the worst of inflation yet, and how this will impact your wallet. So make sure to watch this video until the end, so you don't miss out on any important information. And of course, stay tuned for our upcoming videos. Without further ado, let's dive right in. Coca-Cola has quit the U.S., at least that's what some headlines are suggesting after it was reported that the company will be laying off hundreds of employees and closing several plants in the country. But Coca-Cola has actually been trying to quit the U.S. long before the pandemic. In 2019, the beverage giant announced that it would reduce its workforce by 1,200 positions in its North American operations. The company said at the time that the job cuts were part of a plan to streamline its business and focus on growing faster and operating more efficiently. Coca-Cola also explained that the layoffs were not a reaction to any particular event or economic condition, but rather part of a long-term strategy to adapt to changing consumer preferences and market dynamics. The company noted that the affected employees were primarily based in its Atlanta headquarters and other office locations across North America. However, this isn't the only sign that Coca-Cola is losing interest in the U.S. in 2020. The company decided to close 2 of its plants in the country, one in Oklahoma and another in Texas. Again, Coca-Cola said that these closures were part of its efforts to optimize its production network and improve its supply chain efficiency. But some industry experts believe that there's more to the story. They argue that Coca-Cola is facing challenges in the U.S. market due to several factors such as increasing competition from other beverage companies, shifting consumer trends towards healthier drinks and higher input costs. These challenges have been exacerbated by the COVID-19 pandemic, which has led to a decline in demand for soft drinks and other non-essential items. As a result, Coca-Cola has been forced to take measures such as reducing its workforce and closing plants in order to cut costs and boost its profits. But recently, Coca-Cola made another announcement that shocked the industry and raised concerns among consumers. The company revealed that it will be increasing the prices of its products by an average of 7% in 2023. This move came as a surprise to many who had not noticed any changes in the quality or formula of Coca-Cola drinks. In fact, Coca-Cola has been trying to convince its customers that the price hikes are necessary to maintain the quality and consistency of its products. The company stated that the cost of raw materials, energy, and transportation have been rising in recent years, putting pressure on its profit margins. Coca-Cola added that it had absorbed some of these costs, but that it needed to pass on some of them to its customers in order to keep its business sustainable and profitable. But here's the thing, since Coca-Cola sells its products to retailers in the U.S. in advance, most grocery stores won't feel the impact of these price hikes until their current stock runs out. That's why you haven't seen major price increases on Coca-Cola products at supermarkets yet. However, some retailers have already started to raise prices, and others will follow suit soon. And that's why people are rushing to stores to buy as much Coca-Cola as possible before the price spike takes effect. Now, you might be wondering why Coca-Cola is only raising prices in the U.S. since it operates globally. Well, the truth is that the company has increased prices everywhere. However, the impact of these price hikes varies depending on the country's inflation rate and currency exchange rates. For example, Coca-Cola raised prices in Europe by an average of 8% in 2022, while in Latin America, the increase was around 10%. In Asia Pacific, the price hikes were more moderate, ranging from 5 to 7%. However, in the U.S., the price hikes have been more muted than in other regions due to lower inflation and a stronger dollar. This has given consumers the impression that Coca-Cola prices are not going up, but that's about to change. According to a recent report by BMO capital markets analyst Peter Galbo, food makers are bracing for a significant jump in input costs this year, which will likely lead to more price hikes. Galbo estimates that the cost of grains could rise by 20%, while the cost of metals, chemicals, fertilizers, packaging, fuel, and pulp will also increase by double digits. He says that food makers have been absorbing some of these costs, but that they'll have to pass them on to consumers sooner or later. We think the consumer will ultimately bear the brunt of these increases. He says, the food industry is in a tough spot with costs continuing to go up significantly and the consumer already stretched thin. That means that the era of cheap Coca-Cola is coming to an end. And the perfect storm that's forming will make the price spike worse. A new report just revealed the perfect storm that's forming will make the price spike worse. You see, the perfect storm that's forming is made up of three main ingredients: a tight labor market, a resilient consumer, and high inflation. According to Bank of America economists, the U.S. labor market is the tightest it's been in decades, with near record low unemployment, a booming job market, and wage gains outpacing inflation. This means that workers have more bargaining power than ever before, which could lead to more wage increases and higher prices. The second ingredient is a resilient consumer, who has been able to withstand the shocks of the pandemic and the economic crisis. Thanks to stimulus checks, low interest rates, and pent-up demand from 2 years of the pandemic, Americans have continued to spend money even as inflation has soared. This has kept prices high and businesses profitable. The third ingredient is high inflation, which has been the highest in 4 decades. High inflation means that consumers have less purchasing power and businesses face higher input costs. This creates a vicious cycle where high prices lead to higher wages, which leads to higher prices. Bank of America economists say that this perfect storm could push inflation to 8.4% in the first half of 2023, with no relief in sight. They also warn that the Federal Reserve may need to raise interest rates even further than expected to bring down inflation. We think the combination of a tight labor market, resilient consumer, and high inflation will push headline CPI inflation to 8.4% in the first half of 2023. They write in a note to clients, "We continue to believe that the Fed will need to tighten policy further than currently priced in by markets." That means that the price spikes we've seen so far are just the beginning, and that we have not seen the worst of inflation yet. So if you're planning to stock up on Coca-Cola or any other product, do it soon before prices go through the roof. What do you think about this new price spike? Will you still buy Coca-Cola, or will you try to find a cheaper alternative? Let us know your thoughts in the comments below. We appreciate all of your support and hope you stay tuned for our future videos. Thank you, and until next time.